Hi everyone, this is Jamin Kirkwood from Secure Financial Management with your 2016 first quarter economic update. In this video, we'll talk about some of the economic headlines that influence markets during the first quarter and give you some insight into what they might mean for you as an investor. Please stay tuned to the end for a required disclosure statement. Like many things with investing, patience is often a virtue. For an illustration of why it matters, simply look at the opening quarter of 2016. Stocks plunged in January and fell further in early February, and a bear market seemed a possibility. Then Wall Street staged a turnaround. The Dow staged its greatest quarterly comeback in 83 years, rising more than 7% in March alone and ending March slightly positive year to date. The S&P 500 and Nasdaq each gained more than 6.5% in March. It was a quarter marked by rebounds in stock indices, in some key economic indicators, oil prices, and positive sentiment. Even terrorist attacks could not deter the markets, and the central bank decisions of the quarter only helped. In domestic economic health, arguably the most reassuring development of the quarter for Wall Street occurred in March, when the Federal Reserve not only refrained from raising interest rates, but also scaled back its forecast for rate hikes across the rest of the year. A revised outlook issued by the central bank showed a consensus forecast for 2 rate increases rather than the previously assumed 4. The Federal Open Market Committee also lowered its median projection of where the federal fund rate would be by the end of 2016 to only 0.9%. In global economic health, while the Fed was tightening, other central banks were easing. After years of battling deflationary pressure and an unsuccessful 3-year asset buying campaign, the Bank of Japan made an unprecedented monetary policy move in January and cut the benchmark interest rate below 0. 2 months later, the European Central Bank ramped up its stimulus efforts. It slashed all of its key interest rates, expanded the scope of its bond buying program, and announced a new round of targeted loans to banks that will begin in June. As we look back and look forward, a lengthy winning streak was snapped in the first quarter. The Nasdaq had its first down quarter since 2009. The Russell 2000 also lost ground, retreating 1.9%, and the Dow and S&P finished slightly ahead of where they began the year. Could the second quarter of 2016 be calmer and better than the first? Stock market performance seemed remarkably tied to the rise and fall of oil prices during the beginning of the year. And perhaps that will prove far less true in Q2. Appetite for risk appears to have returned, and investors are again focused on market fundamentals. Nothing suggests this next earnings season will be a good one, but employment and manufacturing indicators have been encouraging, and at the same time, inflation is still tame. If stocks did in fact find a floor in the first quarter, they certainly did not leave volatility behind. Some major downside risks still lurk, from the ISIS terrorist threat to weak corporate profits and the possibility of the United Kingdom exiting the European Union. Still, an investor could reasonably believe that the next 3 months may contain more positives than negatives for the economy and perhaps also for the markets. That's it for the 2016 first quarter economic update. As always, if you have any questions or concerns about what we've discussed, please give our office a call at the number below. Once again, this is Jamin Kirkwood with Secure Financial Management, signing off. Please remember that nothing we discuss here should be considered a recommendation. If you would like to discuss your personal financial situation, please give us a call at 210-428-6250.